in terms of interest rates, if we're right on inflation, then we think the first thing that will happen is the Fed and other central banks will pivot. The Fed will pivot first because we have an extra force fighting inflation. It's called the strong dollar. And the dollar's been extremely strong, up 25% in the last year or so. And that's a powerful anti-inflationary force. And we think the Fed will first change its rhetoric, and the market will rally just on a change in rhetoric. And then we think it will actually start cutting interest rates at some point next year. We will be in a recession. We do believe we've been in a recession. Yeah. We see the inventories being disgorged within the next year, and the Fed will be facing falling prices. So we think it will ease, and I believe other central banks will follow.
Hello and welcome to Money Talks. In today's video, ARK Invest CEO and CIO Cathie Wood updates about the current state of crypto market following FTX collapse, the future of Bitcoin and regulations needed in the space, along with her stocks on inflation and interest rates.
China probably started. And if you look at some of the central bank actions of late, whereas they were following the Fed, now they're pulling away a little bit. The Bank of England had to pull away because of the liability-driven investing excesses and margin calls and so forth. Their near Lehman moment, as they would say. So they've had to pull away. We saw Australia raising its interest rates 25 basis points instead of the 50 to 75 basis points. China is saying it's going to ease. And one of the other reasons they're changing their spots is they have certain limits in mind for their own currencies in terms of how much will they let them depreciate. Both Bank of China and the PBOC and the Bank of Japan have effectively said, you know, we are going to intervene so that our currencies don't depreciate that much more. And what that means is they are selling dollars and buying back their own currencies. So they're actually adding to dollar liquidity, an effective easing out there, not starting with the Fed, but starting with other central banks.
Investment house ARK Invest continued a buying spree of Coinbase stock, adding a total of 296,586 coin shares to its exchange-traded funds.
Every model that we do has a bull case, a bear case, and a base case. So yes, we do say, oh, what could go wrong? And I can tell you right now that I have never seen in my career the 5-year rate of return expectation that we have in our portfolios right now. So much so that even the bear case meets our minimum hurdle rate of return, So a compound growth over a 5-year period, so per year averaging 15%. Our bear case meets that minimum hurdle rate of return.
Wood is a staunch Bitcoin bull, saying on Peter McCormack's What Bitcoin Did podcast that she personally holds around $7 million of the digital asset. After the collapse of FTX, Wood said that she still believes Bitcoin will hit $1 million by 2030. Sometimes you need to battle test. You need to go through crises to see the survivors. We think Bitcoin is coming out of this smelling like a rose.
In terms of where we are, we're in this downturn primarily because of inflation and interest rates and fears about how long it's going to take the Fed and other central banks to get inflation in particular under control. Now, there are two ways of looking at this inflation. One, which it seems the Fed and the ECB are using, is, you know, this is a lot like the 70s. It was inflation that became embedded, and the Fed had to really strangle it out of the system. So that's the way they're going about it. The other way of looking at it is that this inflation happened because of a major supply shock. Started with COVID. I never would have dreamed supply chain issues would last for 2+ years, but they have. And then, of course, Russia invaded Ukraine. And so we've had that supply chain issue, that pricing issue. So if this is a supply shock and was really a 15-month problem, that's how long it took the Fed to really turn around and say, wait a minute. It is not a 15-year problem. If you look at the 70s inflation, it started, at least in the United States, because of the Vietnam War, 1964, and the Great Society programs that President Johnson put in place, all kinds of new social programs, also 1964. We went off the gold exchange standard in 1971. Oil prices quadrupled, and all hell broke loose for the rest of the decade. We got to double-digit inflation, and it was really hard to pound it out of the system. Federal Reserve Chairman Volcker gets credit for it, and he was very brave and courageous to tackle it the way he did. I think Chairman Powell here in the United States thinks that he is the reincarnation of Chairman Volcker. And I think that's a mistake, because this is not a 15-year problem. It's a 15-month problem that the Fed started tackling, and we were already beginning to see deflation.
ARK is an actively managed ETF that invests in companies targeting disruptive innovation, including areas such as automation, robotics, and artificial intelligence. ARK-F invests in equity securities of companies engaged in the fund's investment theme of fintech innovation, while ARK-W aims to capture internet-based products and services, cloud computing, artificial intelligence, e-commerce, and media innovations.
And of course, now, if we're right, we're going to start seeing deflation on a month-to-month basis, and we wouldn't be surprised to see CPI negative year over year at some point next year. If we're right, what has happened during the last 2 years is going to flip, and we think the market will flip back to a preference for growth stocks and our innovation strategy.
ARK's purchases of coin look like a typical Wood double down, though with the fund manager stating last month that the collapse of FTX benefits the crypto industry as it further helps to strengthen the infrastructure and the thesis of the digital currency.
The layoffs that we're seeing are in companies that we might say used to be considered the disruptors, like Meta Platforms, formerly Facebook, Netflix. They were disrupting the media world, the advertising world dramatically, and they have been for years. But guess what? TikTok came along and is taking all the oxygen out of the room, meaning real competition for mind share, the consumer's mind share. So the formerly disruptors are now being disrupted. We didn't own those names, certainly not in our flagship strategy. In some of our very specialized strategies, perhaps we did. But we didn't in the flagship for exactly that reason. We saw that disruption happening. And yet, very interestingly, Meta Platforms, Netflix, the FANGs generally, are at the top of most growth portfolios, and especially large cap growth portfolios. We are highly differentiated that way. We are looking for the new disruptors. And the reason they may be putting on hiring freezes is not because they're being disrupted. It's because they're investing so aggressively and the market's so focused on cash flow and cash on the balance sheet that they are reining in some of their growth programs in the short term, but they are the disruptors. So that's the distinction I would make.
So, what do you think about Cathie Wood's decision to invest in Coinbase? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.